Hello everybody, it's Yashar here, back again with another video, and in this video I'm going to talk about Killam Apartment Real Estate Investment Trust. I will discuss their business, their future plans for 2022, their dividends or distributions, the risk associated with this company, and finally I will provide a detailed stock analysis using my personal discounted cash flow model and using fund from operation or FFO for REITs, and will then provide you with a fair value for this REIT depending on your investment goals. The company HQ is located at Halifax, Nova Scotia, and their shares are traded on TSX for almost 21 Canadian dollar at the time of recording this video. They pay a monthly dividend with a yield of almost 3.27%, and the market capitalization of the company is around 2.46 billion Canadian dollar. In addition to the monthly dividend, Killam had a very nice capital returns in the last few years, which outperformed TSX index in the past 5 years, and this is amazing for the Canadian REIT. I think nobody on YouTube has ever talked about Killam REIT before, but I really think this company deserves more attention, as this is, in my opinion, the best Canadian apartment REIT that you can buy in the market at the moment, with consistent dividend increases and a strong growth potential. Before starting the video, I want to emphasize that I'm not a financial advisor, and this video is not a financial advice for you to buy, hold, or sell this stock. This is just my personal opinion, and should always do your own research before making any financial decision. With that being said, let's start this video. Killam is the largest real estate investment trust in the East Coast. They own and manage multiple properties in Nova Scotia, PEI, Newfoundland, and New Brunswick, and have a large exposure to real estate market in this area of the country, where the price of real estate and land exponentially increased in the last 2 years. And we have an insane amount of immigration to the East Coast, which will continue to increase the real estate prices here. Killam owns over 18,000 suites, including condo apartments and townhouses, manufacturing housing sites, commercial properties, and seasonal resorts. While most of their suites are located in Nova Scotia and other provinces in East Coast, they have a nice geographical diversity across various provinces in Canada, including Alberta, Ontario, and British Columbia. I personally lived in one of their properties when I was a student, and it was a good experience for me. Actually, in the last investor presentations, they show that 87% of their tenants are happy with the Killam, and this is in line with my personal observations. I think they manage the properties much better than other companies, and this is an edge for Killam compared to other apartment REITs like CAPREIT, in my opinion. Killam will expand their business mainly by buying and developing new properties in various provinces in Canada. They particularly have plans to diversify from East Coast and increase their exposure to other real estate markets in Canada, and aim to generate 40% of their net operating income from non-Atlantic provinces in 2025. The main mechanism to raise funds in REITs are share dilutions, and Killam actually did share dilutions in the past in order to fund their operations, as you can see here. But this is totally normal for REITs. What matters to me is that they use these funds to grow their business and ultimately return value to the shareholders via expansions and exponential growth. In the same period, total assets, operating cash flow, and free cash flow of the company increased significantly, which means the management know what they are doing and they are creating value for investors. Killam was able to outperform TSX index, and its share price increased by almost 65% in the last 5 years, and this is without considering monthly dividend. Part of this increase in the share price was because of the growth in the underlying business and underlying assets. In terms of the business growth, they were able to consistently grow their FFO or funds from operation by almost 18% year over year in the last 5 years, while maintaining almost 97% occupancy for their units. Additionally, in the last few years, they improved almost all aspects of their balance sheet, including the revenue, their investment in new properties, and so on. They also were able to improve their margins and increase their revenue and net income from same properties in almost all the markets in 2021 except Alberta and PEI. These numbers are just amazing and show how Killam were able to increase their managing efficiencies year over year. The company has an excellent track record of paying dividend, or I should say distribution, as this is a REIT, and increasing their distributions year after year. They currently pay 70 cents per share in dividend annually, which is an annual 3.27% yield. They of course pay this dividend monthly. This yield is not really attractive for a REIT comparing to other REITs out there which pay distributions with 4, 5, 6 and even 7% yield. But they are conservative in terms of the dividend payout ratio, and they pay close to 76% of their adjusted FFO to shareholders, which leaves them with a room to increase dividends in the future. In the last 5 years, they actually increased the dividend by only 4.5% year over year, which is a very small increase in the dividend, but it is in par with their FFO per unit growth rate. It seems Killam management is more focused on consistent capital growth and distribution growth, which is a great thing for long-term shareholders. Killam was able to collect almost 97% of their rents in 2021 and increase their rents by close to 3% year over year, which is amazing numbers considering the global pandemic and lockdowns, and that's mainly because Killam is a residential REIT and everybody needs a place to live in. Their dividend payout ratio is also low, close to 76%, which is definitely lower than the average REITs in Canada. It means their dividend is also pretty safe and they will probably be able to continue to grow their dividend year over year. They also have a low debt to assets ratio of 45%, which is not the best debt ratio in the world, but it is relatively healthy for a REIT. Overall, while raising interest rates environment is not good for REITs, I don't think Killam will be in any significant hardship in the near future, and I'm not concerned with the debts or their ability to pay the dividends. This is my favorite part of the video, where I can show you my stock analysis based on the financial data I discussed in the previous parts of the video. I use a discounted cash flow model which basically estimates value of the stocks based on projections of their future cash flows. So I make some assumptions about the growth of the company in the next 10 years and then discount the future cash flows into the present value of the stock based on my expected rate of return. So I start with the past 4-quarter FFO per shares of the company, and then based on 3 different scenarios, I predict the future FFO of the company in the next 10 years. In the bear case, or the most negative case for the stock, the company can grow 9% in the short term, and then the growth term will drop to 8% in the long term. The 9% growth is coming from growth in the business, in the value of the underlying assets, and also the distributions. I try to be a little bit negative about valuations of the residential REITs in a bear market and consider a terminal multiple of price to FFO of 12 for this case. For normal case, I considered a little bit better growth and a terminal multiple of 18, which is historical average multiple for this company. For the bull case, or the best possible outcome, I consider the business grows by 15% in the short term, and then the growth rate drops to 12%, which in the long term, and I consider the terminal multiple of 24, which is the bull multiple for this company, and it is absolutely optimistic outlook for market valuation of a REIT. For growth stock, I usually expect 15% return, and for dividend stable stocks, I expect 10% return. So if I give 50% chance to the normal case, a 25% chance to the bear case, and 25% chance to the bull case, and if I expect a 10% return from Killam, the fair value of this company is 21.67 Canadian dollar at the time of recording this video, which means compared to current share price of 21.41, the shares are traded at 1% discount today, which is a buy according to the model. It means if you expect 10% return on your money, the stock is probably going to deliver that 10% year-over-year return in the next 10 years. It's always fun to see what analyst predictions are for a company, and according to Yahoo Finance, the analyst price target for this company is currently at $25.94 Canadian per share for 2022 with a strong buy rating. At the end of the day, if you want exposure to residential real estate market via a REIT and get paid monthly, Killam can be a great stock to look at, as it has strong fundamentals and nice growth potential. Apartment REITs are usually traded at a premium compared to other REITs in the market, as they are recession-proof investments because everybody needs some place to live on. But in my opinion, Killam is trading close to its fair value at the moment, and this can be a good opportunity to buy this amazing company at a fair price. Personally, I own Killam properties, and I would continue to buy Killam REIT here as it can provide 10% return year over year, and in my opinion, it's fairly valued at the current share price. I hope you enjoyed the video, and if you enjoyed the video, please leave a comment and let me know which stock you want me to review next, and please consider subscribing to the channel to see similar videos. Thank you for watching, and I'll see you in the next video.